Okay, I need you to picture something. It is Sunday evening. Right now, silver is sitting at roughly $69.80 an ounce. That sounds totally unremarkable, right? Just a number. Until you pull up the chart and realize that 2 months ago, on January 29th, 2026, this exact metal hit just over $121 an ounce, an all-time nominal high. And then, in the space of a single Friday session, it suffered one of the most violent single-session sell-offs of this entire cycle. Not a normal correction, not a healthy pullback, a shock event, the kind of move that leaves traders staring at their screens wondering whether they are watching a market or a liquidation accident in real time. So if you are sitting here confused, if you lost money, or if you are trying to figure out whether $69 is a gift or just a rest stop on the way lower, this video is for you, because what happened here was not random. It was a warning shot about leverage, liquidity, and what happens when too many people crowd into the same so-called safe trade at the same time. Let's go. You cannot understand the crash without understanding just how absurd the run-up was. Silver had more than tripled from roughly $30 a year earlier, and then went almost vertical in January. That is not normal for any asset. And it is definitely not normal for something people buy specifically because it is supposed to be stable. So what drove it? Three forces, all powerful, all real, all converging at the same time. The first force was structural. Silver has now been in a supply deficit for 6 consecutive years. That means global demand has been outpacing mine production every single year since 2021. And when that happens for long enough, the market has to do one thing. It starts leaning harder and harder on above-ground inventories that are not unlimited. Total annual mine production runs around 820 million ounces. That sounds like a huge number until you remember how many different parts of the global economy now depend on silver at the same time. The point is simple. The gap between what gets dug out of the ground and what the world actually wants to consume is real. It is physical. And it does not disappear because a hedge fund decides to dump a futures contract. That deficit had been quietly building pressure under the market for years before price finally started reacting to it. The second force was industrial demand, more specifically, the energy transition. Solar had become one of the biggest industrial demand pillars for silver, and rising silver prices were already putting real pressure on the manufacturers who depend on it. Then you add electric vehicles, power grid build-out, AI data center infrastructure, and advanced electronics. And suddenly silver is no longer just a metal. It is a critical input into some of the most important technology and infrastructure build-outs of the decade. Now, to be fair, manufacturers are not sitting still. They are actively trying to reduce how much silver goes into each solar panel through a process called thrifting. And that matters. But here is the key point. There is still no perfect drop-in replacement that avoids meaningful trade-offs in either efficiency, performance, or cost, which is why silver remains deeply embedded in the industrial story, even as usage per unit gradually comes down. So yes, the industrial thesis was real, and yes, it still is. The third force was pure macro fear. The Federal Reserve had cut rates 3 times in a row at the end of 2025. Inflation data was still running hot enough to keep everyone uncomfortable. Deficits were enormous. Confidence in the long-term purchasing power of the dollar was getting shakier. And when that combination hits, inflation anxiety, fiscal stress, rate cuts, and political uncertainty, people start reaching for hard assets. So precious metals became the trade. Everyone was in it. Institutions, ETF buyers, retail traders, leveraged hedge funds. And this is where the story gets dangerous. Because by late January, silver had stopped being just a structural thesis and turned into something much more fragile, a crowded momentum trade. And that distinction, structural thesis versus crowded momentum trade, is the single most important thing to understand about what happened next. On Friday, January 30th, it all came apart. Gold got hit hard. Silver got hit much harder. At its worst, the move briefly erased more than a quarter of silver's value in an incredibly short window. And if you want to understand why it happened so violently, you have to separate the spark from the fire, because they were not the same thing. The headlines wanted a villain. They got Kevin Warsh. President Trump confirmed he would nominate Warsh as the next Federal Reserve chair, replacing Jerome Powell. That headline landed, and markets moved fast. But here is what matters. Warsh was a catalyst. He was not the cause. The real story is that markets abruptly repriced. The rate path, inflation risk, the US dollar, and the broader policy outlook all at once. As real yields and the dollar pushed higher, silver, which is naturally much more volatile than gold, reacted violently. That repricing had been building under the surface already. The Warsh headline did not create the instability. It simply gave the market a reason to release it all at once. And then the mechanical side of the market took over. This is where the move stopped being sharp and became historic. Because when you are levered long and the price breaks below key levels, your broker does not care whether your thesis is brilliant. They sell first. And they sell automatically. That is how margin works. So when thousands of leveraged positions all start getting squeezed at the same time, you get a chain reaction. Price falls, margin calls hit. Forced selling begins, price falls more margin calls, more forced selling. And silver, because it trades in a thinner, more speculative market than gold or major equities, gets absolutely obliterated in that kind of environment. This is what traders mean when they call something a liquidity cascade, not because silver suddenly became worthless, but because too many people were holding the same trade with too much leverage at exactly the wrong moment. As Luigi de Bellis of Equita described it at the time, this was a liquidity event, where risk limits, margin calls, and volatility control strategies all started firing at once. And because silver was thinner and more crowded than gold, it absorbed the stress much more violently. That is why the drop looked irrational. Because in a way, it was. Not irrational fundamentally, irrational structurally. So what actually broke? Three things, and they broke simultaneously. Easy money expectations got repriced, not because of one person, not because of one headline, but because the market started realizing the path to easier policy might not be as smooth as it had priced in. That removed a major pillar from the silver bull case. Crowded leveraged longs got liquidated, mechanically, brutally, without any regard for whether silver's underlying long-term story had changed at all. This was not a calm reevaluation. This was a forced unwind. And industrial optimism ran into macro stress. Geopolitical instability did not end up being straightforwardly bullish for silver. Instead, it fed into a broader environment of inflation fear, policy uncertainty, and risk reduction, which meant investors started cutting exposure across the board. And when all three of those narratives break at the same time, inside a crowded, leveraged market, you get exactly what silver gave you that Friday. One of the most violent precious metals sessions in decades. That is the full picture, not one person, not one headline, not one magic explanation. Three narratives breaking at once. And this part matters too, because silver's sharper collapse relative to gold was not random. Silver has a dual identity. Gold is primarily a monetary asset, a safe haven, a fear trade. Silver is all of that too, but it is also deeply tied to industrial demand, which means silver is more sensitive to economic outlook, risk sentiment, cyclical expectations, and growth fears. That is why silver usually behaves like gold with an amplifier attached. When the market loves precious metals, silver often outperforms. When the market panics, silver often gets hit much harder. And that is exactly what happened here. Same asset class, different stress response. So now here we are, Sunday evening. March 29th, 2026. The U.S. futures market is reopening after the weekend. Silver is trading around $69.80, down sharply from that January high, yes. But the important question is not where it has been. The important question is, what does the setup actually look like now? And the answer is contested. Not broken, not healthy, contested. Technically, the market is trying to stabilize around the $70 area. That is the first zone that matters. If that level fails and sellers regain control, silver can absolutely revisit the mid-60s before it finds stronger support. But if buyers step back in with real conviction, and if the macro backdrop starts helping instead of hurting, then the next serious recovery conversation begins in the low to mid-80s. That is the battlefield right now, not a clean trend. A market trying to decide whether the flush is over or whether it has one more leg left. Fundamentally, the picture is actually more encouraging than the chart makes it look, because the structural story did not get invalidated by the crash. The supply deficit did not disappear. Industrial demand did not collapse. Solar did not suddenly stop needing silver. What changed was the financial overlay sitting on top of those fundamentals. The leverage got flushed, the speculative excess got reset, and silver is now being priced without the easy money tailwind it had been leaning on through 2025. That may not feel good in the short run, but in a strange way, it is actually a healthier starting point for the next real move. This is where the answer gets honest, because the range of forecasts out there right now is wide, and that tells you something important. The market is still uncertain. Broadly, serious forecasts still span from the mid-50s on the cautious end to the low to mid-80s on the bullish end. That is a huge range. And the reason it is so wide is simple. Silver's next major move probably won't be decided by silver alone. It will be decided by what the Fed signals next, What happens to real yields? What happens to the dollar? And whether the industrial demand story keeps holding up as manufacturers push substitution and thrifting further. That is the real battleground now. Not hype, not emotion, policy, and whether the macro backdrop turns from a headwind into a tailwind again. So here's the honest bottom line. The January crash was not a story about one person derailing silver. It was a story about what happens when a genuinely compelling structural thesis gets overloaded with leverage, crowded with momentum traders, and then hit simultaneously by a macro repricing, a margin squeeze, and a full liquidity shock, all on the same Friday afternoon. And that matters, because the fundamentals did not collapse on January 30th. The financial structure sitting on top of them did. That is the difference. And right now, with that structure reset, with the speculative excess cleared out, and with silver sitting around $69 as futures reopen, this market is a very different animal from what it was during the January frenzy. Whether this price is the floor or just a temporary stop on the way lower depends on one thing above everything else: what the Federal Reserve does next. That is the variable that unlocks the next chapter of this story, and it still has not resolved, because the next move in silver is probably not going to be decided by silver itself. It is going to be decided by the Fed. And in the next video, I am going to show you the exact Fed dates, the key signals, and the price levels that will tell you whether silver is actually bottoming here, or whether this market is setting up for another break lower. So if you want that breakdown, hit subscribe, drop a comment, and I will see you in the next one.